Hello and welcome back. Shopify is actually crashing today. It's actually 18% down right now, even after reporting an earnings beat, which you would expect that it would bring the stock price up, right? Now, I have made a video about Shopify before and I kinda warned people that Shopify is very overvalued. And in this one, I actually wanted to explain why and actually also give you a discounted cash flow model to explain the price that I would be willing to buy the stock today. And again, that's based on what the stock is doing financially, because when you're investing in something, you want to make sure that you are gonna be making your money back and then some. And so in order to verify that you're going to be making money, you need to look at the financials of the company and see how well they are doing and if they are already making money, because what else do you have? And so let's start by taking a look at the company. And again, it's down 18% right now and trading at $730, which is significantly down from what it used to be. It used to be about 1800 over here. And the outstanding shares of the company are sitting at 125 million here, and you will see that they are also getting massively increased. And that's something that you also don't want to see as an investor, because if you bought at this level over here, you are now getting massively diluted. The company actually printed 50 million more in shares till today. You see that from 70 million to 126, 5 or 6 million over there. And so this is almost doubling the outstanding shares, which is it's about 80% or so, which is massive, because if you owned actually, let's say 1 out of 10 shares of a company, and then the shares count is actually doubled, now you own half of that just because you got diluted. And so this is problematic for an investor, because they end up getting diluted and losing value out of their shares. Not great to see. So let's take a look at the company's financials here, and we're going to start with the income statement, see what's going on with the company. And again, at the very end, we're going to examine the financials in terms of a discounted cash flow model, which is going to tell us the truth about the company's cash flow and how to project revenues into the future and cash flow into the future as well. The interesting thing about the company, it's increasing its revenues, which is good to see. So there's year-over-year growth, which is similar, like 80 to 70%, and increasing. So that's actually very nice to see. Now the net income of the company is also increasing from losing money back in 2017 to now making $3.5 billion. So this is great to see for a company. It looks like the company has future for sure, but the thing is, we want to discover whether it actually makes sense for us to buy today at that price, because there's only one price we can buy the company today. This is the price. There's no other price that we can buy the company today. And so we want to be making sure that if we buy this company today, it's a good investment for us. So we're buying it at a cheap price, at a price that we could be making money in the future. Because if we buy it at an expensive price, we could end up being 20% down, as is what's happening today. And there are some investors that have unfortunately been burned from that. Let's take a look at the balance sheet now. So, two things very important about the balance sheet here. The total assets of the company sitting at $13.5 billion, and the total liabilities is very important as well, because it shows us how much debt the company has to fulfill in the future. That's 2.1 billion, which is a fraction of their total assets, so that's good. Cash flow. Now remember, the company actually really massively diluted investors, so they got a lot of assets because of investors buying stock of the company. So you have to bear that in mind. I mean, there's a lot of investors that actually paid for the assets of the company, so they are funding the company directly. And this is why you're seeing so many assets actually in the company. It comes from investors, and that's typically not great to see. Unless the company, of course, is making money on their own. So that's a different story. So here, the cash from operations is positive, which is always, of course, a good thing, because the company is making money, so that's good. But the cash from investing is negative. They're investing in market securities in the last 12 months. That's good to see. It looks like they're investing in the market heavily, really. So that's kind of nice. I like companies that invest in the market, to tell you the truth. It shows me that they actually understand the world of investing and how to invest their money to make profit. Now you could go deeper and see what they are investing in. I don't want them to be investing in very overvalued companies, of course, but the mere fact that they are at least investing their money, it's good to see. Now, cash from financing is positive here every year, and that's not great. And obviously, this comes from issuance of common stock. We saw that earlier, right? They were massively diluting investors. Not great to see. And they also got some debt over here, like the total debt issued, a long-term debt of 1 billion almost, around here in 2020. Free cash flow, the end all be all. Minus 12, minus 18, 13 million, 383 million, and 458 million. Now, the last 12 months free cash flow is sitting at $450 million, yet the company has a market cap of $91 billion. So, let me ask you this. If I'm making, let's say if I'm making $1,000 today for the last 12 months, I have a company that makes $1,000 today, does it make sense for you to buy my company for $100,000? Does it? It doesn't, right? Because you are paying $100,000 for $1,000 of free cash flow, of gains every year. So you have to wait 100 years just to get your money back. That doesn't make sense, does it? The same thing applies with investing, and in a world of super overvalued investments, people may not pay much attention to that. But you, as a cautious investor, you really should be looking at these values here. So the company makes $500 million a year, and it's trading at $91 billion. This is a massive multiple of its free cash flow. Massive, absolutely massive. How massive it is? Let's take a look at the discounted free cash flow model over here. And I have a copy of Roblox here because I used it for Roblox earlier. So let me make it Shopify, just to have a most recent version here. Now, I have already copy-pasted the discounted the cash flows here in year 1 to 5. They're basically the ones that we saw over here, minus 12 to 458. You will see the free cash flows here. And these are the current data, the data that we have, historical data. And it gives us a 5-year average free cash flow growth of 600%, and that's because of this steep increase over here. Of course, we cannot use this insane rate over here. And so what we do want to use is and set it up here is probably something around 10% over here, and maybe even 15%. I'm going to be a little bit generous, and I'm going to give it 15%, which may be a little bit excessive, but I'm going to give it a free cash flow growth per year for the next 10 years of 15%. The discount rate that I want to get, let's say it's 13%, is the amount of money that I want to be making every year from my investment. This has to be more than 10% because just putting your money in an S&P 500 ETF will make you about 10%. So if you are risking it in a single company, in a single stock, you want to be gaining a little bit more, and this is what a discount rate of 13% can give you, and this is why we use this value. And a perpetual growth rate of 1%, which is less than what the whole economy really grows at, is fair. We want a perpetual growth rate level that's going to be less than like 3% or 2% potentially, just to make sure that we're not undermining the whole economy just for our company's sake, really. And so if we use these calculations here and we discount the 10-year free cash flow back to today, plus we add the terminal value, which actually projects the earnings, the free cash flow earnings of the company in perpetuity, really, for the next like 100 to 100 years, it will give us a value of 76. And also notice that I've also added the outstanding shares in million over here, which is 125.6. And you can get that over here. And let me find it for you. It's over here. It's 125.6 million is the outstanding shares, what I pasted over here. And now if we do the calculations, you will see that the price per share to pay today for Shopify, that's per share, is $76.82 today in order to make 13% a year for the next 10 years. And notice where the price of the stock currently is. It's like insane, right? It's like 10 times more. Notice we want to be getting it at 76 and it's sitting at 730. That's insanely, just absolutely insanely overvalued over here. We actually want to be getting this company around these levels, actually these levels over here, not even, maybe these levels. Everything else after that is basically overvalued. And you may be thinking, okay, this will never happen, right? I mean, the company will never go down to 70. Well, maybe it will never go down to 70. But there are so many companies around. Why do you want to own an overvalued company just because it's Shopify and because of the hype? That doesn't make a lot of sense. I mean, you saw what happened to people who invested here. And the thing is, they don't have a margin of safety now because the company is not making money. So they may have to wait for decades for the company actually to start making enough money to justify this kind of insane valuation that it had over here. You don't know what's going to happen. But if you have a company that's making cash flow, money loves money, and so eventually it will grow. It has to, because investors will flock in if there is money to be made over here and the company is making a lot of free cash flow, even if in the short term it's the sentiment is negative. It doesn't really matter. But here, the short-term trend could be negative. The problem is, how do you become positive when you're not making money? And how do you go back to these insanely overpriced levels over here? That's the problem with these kinds of investments. This is why I'm telling you to be very, very cautious about what you are investing in and evaluating companies properly. And this is why it really, really pays to use a model of that sort in order to quickly evaluate how much a company is worth intrinsically. And then you can see how far you are from that and be like, okay, this is intrinsic. The intrinsic value for this one is like $70 and the market value is 730. I mean, myself, I'm not even touching this one for a long time. So yeah, hope that helps you a little bit, and I understand that it may feel, it may hurt a few of you that already own the stock, but I have to be very objective here. I'm not here just to hype up stocks and just tell you to buy this and buy that. That's not my goal. I don't have anything to gain. I'm just giving you an objective evaluation of what I'm seeing here in terms of numbers. It's all mathematics in the very end. And thank you for watching this one. Hope you liked the video. If that helped you a little bit, please like it and subscribe. I'd love to see you around, and you can also join our Discord channel. There is a link in the description box below. And in the meantime, you can take a look at this video that I made earlier, and I'm discussing Alibaba, and I'm creating a discounted cash flow model for that company. Thanks for watching, and I'll see you soon. Bye bye.